All right, welcome back. All right, talk about a tale of two cities. The Fed's got a mess on its hands, or maybe even a pickle, and the consumers do too, right? The Fed raised rates to quell inflation. Now, it's working, but the job really isn't done yet. And if inflation is your responsibility and your mandate, which it is for them, then you still have to be vigilant and worried about it ticking back higher, like it did last week with the CPI. But if the overall economy is also your worry, rates arguably are too high. We just got done talking in the last block about the consumer borrowing more than ever before with credit card rates sky high. And there are reports of 38% of U.S. companies planning layoffs in 2024. In order for the average person to live a middle-class lifestyle, they need to make $120,000 per year, but the average wage in the country is $67,000 per year. People, quite simply, are struggling. Auto and home loan delinquencies are on the rise. Housing is out of reach and getting worse, right? Rates go lower and house prices go up, but mortgage rates go down. Mortgage rates go up and your mortgage payments go up, right? So you got a problem on your hands. There's nowhere to turn. It's a mess. You can cut rates and spur inflation on, or keep them as they are and slowly strangle the economy. My next guest watches this stuff every day, comments on it too. Please welcome into the show Craig Bolanos. He's the CEO of the Wealth Management Group in Chicago. Thanks for being on, Craig. You know, I just feel like they're in a little bit of a pickle. I mean, if your mandate's inflation, I get it. Raise the rates like you did, and then maybe keep them high enough until you wait and see something breaks. But the consumer, I mean, the economy is struggling. There are some banks that are still having a tough time. I just don't know how much longer the economy that has been used to 0% interest rates can stay at 5.25%, 5.5%. What do you think?
Well, here's what I think. Number one, your monologue wasn't like overly inspiring. You had me a little bit nervous. But the reality is we need to change the script. You and I have said this before. Let's quit talking about rates that are higher for longer. And let's just start agreeing that rates should be normal for longer.
Yes.
These rates aren't that high. This feels just like 2005. It feels just like 1995. It doesn't feel that different than 1987. I didn't say 1982. So, I mean, the truth of the matter is here, I think people just, if we're talking about the consumer, everyone knows the secret. We got to start telling our money where to go instead of wondering where it went. We should give everybody, instead of free childcare payments, we should go ahead and give a free budgeting app. That'll cure everything relatively quickly.
You make a great point. And I did this a while back, right before we left for the break. But you go back 50 years and take a look at the average Fed funds rate. Now, right now, it's that range, 5.25% to 5.5%. We're talking about cutting it. Come on, 6 cuts. I mean, and those people, I don't know. I wonder what they're smoking. But we're at 5.25% to 5.5%. That's the rate. You go back to 1971, Craig. The average is 5.42. To your point, right? This is
to my point. Yeah, I can get behind the idea that we have maybe 2 cuts, this year. I'll buy into that, not 6. That's why we've talked before on your show, which is always chock full of awesome content. The market's a little bit offsides now relative to its expectations. And you're seeing that reflected in the high caliber momentum trade as the market's getting comfortable with a 10-year treasury that's back above 4% today. That's going to be a headwind for some time because, again, when it comes to the inflation data, always bet the over, don't bet the under, kind of like the jobs. Now, you mentioned the jobs. Everyone talks that the layoffs are coming, but I haven't seen too much evidence of it just yet, besides my friends at BlackRock and a couple others finally putting some people into the unemployment line.
Yeah, I mean, the Wall Street Journal had a piece, again, before the break, and maybe it was a weekend piece about all the firms that laid off last year. It doesn't get a lot of play because of that JOLTS number, that job openings number we keep looking at, the unemployment rate, and then the monthly jobs number we get from the Fed. But I guess the biggest news that we could take away from that monthly jobs number is that last year, on average, the government was responsible for 56,000 jobs a month. Just because of the spending that they're doing, they were hiring 56,000 a month. Okay, that was double the average of 2022, which was 28,000. Sorry. So there are a lot of jobs being created, but it's been the government deficit spending, really, some of it, that's not good either. So here's what I think is going to happen, and I want you to tell me what you think about, or if I'm right or crazy, but that we're in debt. the 34 trillion, you see the debt clock on a lot of different shows. We owe a lot of money. I think the way out for the government is to inflate their way out. They're going to err on the side of inflation rather than recession or depression. What do you think?
Well, as evidenced by, was it a bipartisan bill coming out of the House of Representatives today, hoping to get done to actually bring back not all of, but some of that child care tax credit, plus some of the business provisions that had fallen off here and expired the previous year? I would absolutely have to bet on the concept of inflating additional dollars into this economy. I do think that's going to happen. And for that reason alone, I think that's part of the reason the Fed is going to say, hey, if we've got additional fiscal stimulus coming because of some compromise in 2024, we should probably continue to keep things a little bit tighter, not looser. Hence, the market should start gripping with that. And I just think, again, all we did was we pulled forward some of the Santa Claus rally. That's all that occurred. I think this is healthy here to have an air pocket of 5 to 7% and let everybody breathe a sigh of relief thereafter.
Yeah, you're speaking to the choir and you're talking a lot of sense. I agree with you, but we have to, I think the longer we're here, Craig, the more people will get used to it. Unfortunately, that's the same with inflation too. And like we've said a lot of times again on this show, but look, if your McDonald's cheeseburger's gone up 50 cents, I'm going to make a bet it ain't never coming back down. I mean, things just go in one direction when it comes to those prices, right? The restaurants and things like that. You never see them lower it. I got 10 seconds.
No, we're just trading off of a new base. Everybody knows that's going to happen. But again, there's something I always think about. You never count out the American farmer. You never count out the American CEO. They're geniuses. And don't count out the American consumer. There hasn't been a knockout punch. I mean, at the end of the day, when I read some of the bank reports, yeah, I know about the average credit card balance. I know about all the revolving lines of credit. But the truth is, these wages have grown very, very well despite the inflationary pressures. And I think people are just going to continue to spend until they can't. And I've got news. That can't isn't going to arrive still in 2024. I think we've got enough runway to keep it going.
All right. You made me feel a little bit better. I hope not. I hope you're right. I'm worried, though. That's my job, is to worry. All right. Appreciate it. Thank you very much. Craig Bolanos, he's the CEO of the Wealth Manager Group in Chicago. We'll see you again next week, Craig. All right.